Hi, this is Stephen Carson coming at you from St. Louis, Missouri, in these United States. Any upfront business? No, not really. Let's bring on Black Horse. Hello, sir.
Good afternoon. How are you?
Very good. As I mentioned on Twitter, we have our 21st wedding anniversary today, and it never occurred to me that there was some other significance to 420 besides Mrs. Radlib and myself getting married. But
Well,
um,
congratulations. 21 years. That's impressive.
thank you. Yeah, it's
Yeah, I guess
the Lord has had mercy.
you guys are 10 years ahead of us.
Oh, okay. So just 10 years difference there.
So
Yeah, we talk about the notion of there's her, there's me, and there's us, right?
yes.
And so us has an age, you might say.
Yeah,
Right?
well, for you guys, you had more life before we my wife was 20 when we were married. I was 22. There isn't nearly
Mm,
as much pre there isn't nearly as much before for us, so
yeah, so in about 10, a little over 10 years, us will have been longer than either of you on your own, right?
yeah, exactly.
That's a big milestone. Um, okay, so we I think it's fair to say that throughout last year, um, well, throughout in my marketing Black Horse, I really put in the context of the last couple of years, right? Obviously, we're a little over a year into the war in Ukraine. That brought about some volatility. We were tracking a lot of that last year, but also there was the whole pandemic lockdown stuff, right?
Yeah.
That started. Wow, I've lost track. Where we're in 2023, so 2.5 years ago.
3 years ago now.
3 years ago. Okay, 3 years ago. And as we'll see, beginning with the lockdowns, there was sort of chaos in the economy, and there's ways to measure chaos. I didn't know this, but
Yep.
Black Horse is teaching me. The market has a way to measure it. You can look at a chart and see. You could call it the chaos chart, I suppose, or the volatility chart. Um, uh, the chaos really kicked in a big way 3 years ago with the start of the lockdowns, and then the war in Ukraine uh, brought in some additional chaos. Though I recall Black Horse that just a couple months after the war, we were noticing that a lot of things were settling down quite rapidly. Um,
Y-
right?
Yeah, we were settling into what would have been the post-COVID world.
Yeah, yeah. Like the war looked a little bit more of sort of a blip for a couple months, and then if you step back and ignore that blip, we were basically on trend in a lot of measures to where we would have been anyway if the war had never happened, right? With some small exceptions, one of which we'll get to today, right?
Yeah.
Um, uh, okay, so I am not on the right slide. Okay, first of all, you wanted to. We don't want to be discouraging, I guess, but in general, but some strategies are better than others. I guess it's fair to say, Black Horse. Some
Yeah.
tactics are, and in particular, this is a really important distinction that I want to highlight, and we've been talking about it in other contexts online, and that is that when you are regime aligned, certain things, certain tactics work well for you. I guess you could say, or at least they appear to work well. When you're not regime aligned and you try to do the same things that the regime aligned people do, the same tactics that regime aligned people do, it doesn't always work out well for you. Usually doesn't. I'd almost go so far as to
Yeah,
say,
there's a lot of
right?
screws that only turn one way in this regard.
Yes, right. And a lot of the stuff that I think we kind of tease people for being boomers in politics, which is in this context a way of saying sort of naive, is I think part of what we're saying is exactly that. You think you can just do what the left does or whatever, and you'll get the results they get. But that's not the world we live in. This is not a symmetrical situation, I guess is what I'm trying to say, right?
Well, there's that element, and then there's the element that you have an entire class of people who have, for the last, 15 years, encouraged people on the right to take symmetrical political action to people on the left. go out and protest, go out and engage in boycotts, go and make yourself loud and heard, and that, vote harder or whatever, and that's the correct way to engage in political activity from the right.
Right.
And the point of highlighting some of these stories is not to, take a dump on the person who is upset with Anheuser-Busch, but to remind people that there's a necessity for a leadership class that wages effective combat on their behalf.
Right. Yeah. Yeah. It's a variant of talking about the populist delusion. So in this particular, and okay, so before we turn to this being ineffective, um, boycotts or protests against companies from the left, I think have usually had results, or have often had results. Is that fair to say?
They've had results. It's interesting to see that they've had in many cases results that were not what the activists would have kind of predicted.
Mm-hmm.
Right.
Yeah, something
So
changed, but maybe not exactly what they were hoping for.
yeah, so if you think back to like 1995, you had this massive left-wing push against companies like Nike for, using low-paid labor in like
Hmm.
the third world.
Right.
And the result of that push was the result of that activism was not that those companies stopped using low-paid labor in the third world. It's that these companies developed alternate strategies to explain to left-wing people why they were actually good.
Yeah. Right. Yeah. Right. 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 They we talk about revealed preference versus what do you call it? Spoken
Stated
preference,
preference, yeah.
stated preference versus revealed. Um, Maybe the companies in a way were more astute that in responding to sort of the feels, will make you feel better about yourself or something.
Yeah.
Um, that was actually the right response, or responding to the real issue, as opposed to really helping people in the third world, which it turned out, maybe people didn't really care that much about.
Yeah, well, I mean, they found a better way to make left-wing people feel good about themselves.
A
And
cheaper
so,
way.
yes, a much cheaper way, as it turns out.
Right. Unfortunately, we all have a price. Okay, so let's turn to an action that was taken by the Boomer Cons, I guess, which is that Dylan Mulvaney, I believe is the name, did a sponsored clip, I believe, as I understand it, a sponsored clip for Anheuser-Busch. And Dylan Mulvaney is an M to F trans. And people were like, hey, you're coming after our beer now with the latest thing, the latest fad. And so we are going to punish you. And so walk us through the punishment here. Note, folks, the scale is from May of last year. Okay, it's about a year. We're looking at 12 months. And over all the way on the right, you see them up at the end of March, early April, down, and then they're coming back up. So
Yes.
where was I'm having trouble telling.
So
Where was the big action taken here against Anheuser-Busch?
the boycott is in mid-April, or sorry, early
Okay.
April, and you can
Early
find the
April.
boycott if you look at the little running
The
bar
bottom.
graph at the bottom.
Yeah.
That's the chart of how many shares of Anheuser-Busch were traded, and so
Right.
you see this like tiny little volatility event in early April.
Right.
But the point here being that the the boycott here of Anheuser-Busch is not sending signals to the market that Anheuser-Busch's business is in significant trouble.
Yeah. Right. Right.
So, maybe the boycott will have results of one kind or another, but your Anheuser-Busch isn't feeling the heat. Let's put it that way.
Right. Right. Yeah. If you have, I don't know, investors or the big investment, the Black Rocks and stuff like that, going, oh, should we be getting out of Anheuser-Busch because they're going down in flames from this boycott? They're going to look at this and go, nah.
Yeah, I mean,
Right.
if you remember the chart we looked at for Peloton when we talked about the tech crash, that's an example of what happens when investors think a company is in structural trouble because
Yeah.
of the decline of their client base. And that's a chart that was down like 95% in a period of 6 months.
Right.
That's not what we're looking at here. We're looking at
Right.
a pretty structurally healthy business based on this chart.
Yeah. In fact, I'm trying to come up with a percentage here. If it went from 65 to 63 or something, then what's
It's
the
like
percentage of?
4%.
Yeah, had a
But
little 4% drop, which seems to have been lasted for a week or
yeah.
something, right?
But if you look at this chart, you'll find drops of that size all the time for all kinds of random reasons. So
Right. Right.
you're not looking at a stock reacting to a dramatic event. You're looking at
Right.
a joke.
Yeah. Yeah. Right. So the point is not to say that there's nothing to be done, just that this sort of thing, uh, it doesn't really, you know,
Well,
no one should be. I mean, we're not going to. I mean, what Steve Turley probably had all the headlines about how they're feeling the pain, and going woke, going broke, and all that, and not seeing it, Steve.
yeah, and equally, if you're sending your money to the kind of conservative class that advocates these kinds of things, we have pretty clear evidence here that that's not the right move for how to fight back.
Right. Okay. Having covered that briefly, let's move on to the defense industry. I guess before jumping to this, just preparatory remarks. I would say both on the anti-war left and the anti-war right, of which I'm a part of, um, we would talk about, what Bob Dylan had a song, "Masters of War," right?
Yeah.
We would talk about the arms merchants and how they're a big lobby. I think that's true, um, for the empire and things like that. But implicit in all of that is that war is good for them, right? Implicitly, you would expect. I mean, if sort of to test this theory, you would say, okay, if there's a war, we should see in the market, we should see the defense industry really rocking and rolling. So you picked Raytheon, not an insignificant defense contractor in the U.S., I gather. Um,
Yeah, so
and
Raytheon is probably the single largest defense contractor for items that are being used in the Ukraine war. So uh, you've got some other, like you've got Martin, and you've got Boeing that sell very expensive things, but they're not things the U.S. is currently sending to Ukraine.
people can see my mouse on screen. Awesome. Good. I can point to things. Okay, so the beginning of the war would be kind of right about that hump there.
Yeah,
Um, and so that makes it look like, hey, people are excited, right? But then it settles back down to really where it was, and now it's kind of back to where it jumped up to when the war started. But I guess to you, this does not look like a ringing, uh, a clear, hey, wow, Raytheon's making out like a bandit on this war, right?
yeah, no. So there's this theory of the war in Ukraine that this is some very effective resurgence of the patronage network.
Of the military
That is
industrial
kind
complex.
That's right. And so if that was the case, you would expect to see great earnings, lots of profits made in the military industrial complex. So, one of the themes we continuously come back to in the Econ mini series is, well, this is the prediction you would expect from the political commentary. How does that relate to the actual business results for the patronage network?
Mm-hmm.
Well, here's the center stage element of the patronage network, and not only is their stock not responding, but if we go over to their earnings reports,
Yeah. Mm-hmm.
they're not making money. Their forward guidance isn't great. Sorry, I shouldn't say
Mm-hmm.
they're not making money. They're not making any more money than they were
Right.
before the war, and they're
Right. In
making
fact,
less money.
2019 looks better, right?
Yes.
Yeah.
Yeah.
Before the pandemic stuff.
So,
They're not back. They're not back to 2019 levels, despite the war.
yes. So just like I made the argument repeatedly that if Iraq was a looting operation for the oil industry, it was a really, really badly executed one. It,
Hmm.
if Ukraine is a boondoggle for the U.S. defense industry, it's not a, it's not serving purpose very well.
So my cynical take here, and feel free to counter this if you want. My cynical take is, well, this is why we have continued to hear about China all along. Like that never really stopped. About sort of hawkish views towards China, and maybe part of the reason is for those who want to like make any money out of this, Ukraine just isn't really moving the needle. You know.
Yeah, I mean, if you look at charts of military spending in the sort of G20 countries,
Hmm.
excluding Russia for obvious reasons, uh, a year in, Ukraine really doesn't look that dramatic. It, which is, it's surprising to me, but it is reality. Um, I'm
Right.
not.
So we'd expect like NATO members maybe would be like buying a lot of arms right now or something, and you're
Yeah,
saying,
well, I
not
got
really.
interested in this because our prime minister was leaked on a phone call to NATO, expressing that Canada will never meet its NATO target in the future. So I kind of got interested in like, well, I know we've sent a whole pile of resources to Ukraine, but what has actually happened to our spending in the military-industrial network? And the answer in Canada is it's kind of gone down. So we sent a bunch of resources there, but the result is just that we have no military at home, which is it's interesting. Uh,
Yeah.
I'm not. This is a value-free analysis of this particular fact cluster.
Yeah. Well, it's like academic agent always emphasizes the first thing is just to understand reality, right?
Yeah. So
And if you sort of a priori decide that the defense industry is doing good from the war in Ukraine, well, something's wrong there because it's not.
yeah, well, and we looked at Raytheon and its earnings, but if we go to the index more broadly,
Yeah. Here we go.
so you see some response here.
So wait, I'm sorry, I'm getting myself adjusted here. So the 2022, so the beginning of the war might correspond to that little peak there,
Yes,
right? That I'm pointing to.
yeah, something like that.
Um, but then it just drops right back down for a while, and then it comes back up. The net result being that to me it looks similar to the Raytheon. It kind of just looks like market fluctuation,
Yeah,
right?
there's nothing here that would indicate to you that there's a dramatic event that favors this particular group of companies.
Yeah, and to be clear, there are times, and we've shown charts like this. There are times where you know when a certain event happened. You can look at a chart and just point to it. It's just totally obvious. You don't have to
Well, if
like
you look at this
look
chart,
at the
you
horizontal axis. You know.
if you look at this chart and block off the bottom, can you locate the lockdown?
Yeah, exactly. Right, like that. Yeah, wee little valley there. And similarly, I think 9/11 charts that included September 11th.
Yeah.
You could tell where September 11th happened, right?
Yeah,
Things
and
like
I
that.
mean, sorry, I want to respond to a gentleman in chat here
Hmm.
commenting about
Sure.
military at home. This is Canada, it's not the United States. The United States has we have very different profiles when it comes to the defense industry. So, anyways,
Um, okay. All right. So I think that's all we were going to say about defense. Um, they're not riding high. I mean, I guess what we'd want to see if we really believe to really make us go, oh, maybe there is something to this. Uh, they're doing well with the Ukraine war. We would see when the Ukraine war began roughly on this chart, and then it would kind of like it would either jump up and stay up there, or it would keep climbing from
yeah,
the beginning of the war, right? Something like that.
well, if the support of Ukraine was material compared to like previous spending with these companies,
Hmm.
you would see good earnings after the start of the war, and you would see response in stock price. You don't see
Yeah.
any of that, which means that you know we're not seeing a substantial reorganization of the defense budget. And I chose to look at this rather than at government spending numbers because regardless of where the dollars are coming from, whether they're coming from British taxpayers, German taxpayers, American taxpayers, or Canadian taxpayers, they all end up in the pockets of the same collection of defense producers, and so you're probably better off to look at the stocks and earnings of the defense contractors in order to evaluate Western military spending than you are to look at the official military spending numbers because who knows what they're spending that on.
Mm.
So it's a data point worth filing away.
Yep. Okay. So now let's turn to our main story, which is, as I was saying at the beginning, starting with, well, we see it on this chart. Starting in early 2020, we saw, oh, wow, that is 3 years ago. Wow, it's almost exactly 3 years ago. Yeah. You can just see it, that there was something big that happened, namely COVID and lockdowns and all that sort of stuff. Um, so what is going on more recently? Now, I don't know if you want to try to explain this like you explained it to me briefly, executive summary, but this is called VIX, and it is a measure of volatility, or you could even call it sort of a measure of chaos. Is that unfair, Blackmore?
Yeah, so this is a measure of so the VIX is a measure of the at the money short term implied volatility of S&P 500 options. So it's a very accurate measure of the perceived volatility risk in the sort of in the S&P 500, which is the 500 largest companies nominally incorporated in the United States that kind of stretch
Mm-hmm.
across the U.S. empire.
Right.
So typically, VIX spikes occur during moments of uncertainty and severe market decline. So you can see here, I pulled, I think it's a 10-year chart. You can see the most dramatic spike in recent history here is the pandemic. But what
Right.
I wanted to point to is the fact that for the entire post-pandemic period, volatility remained consistently higher than it had the previous 7 years.
Mm-hmm.
So it's
Right.
not that the spikes are higher, but the valleys are quite a bit higher than they had been in the previous period. And I think it's fair to say that it reflected an environment where there were underlying dramatic stories going on that affected financial markets.
Right.
So the what I wanted to highlight in today's stream is that we're finally now, 3 years on, starting to see consistent downward trend line, lower highs, lower lows for a long period of time. Um, you know, for volatility returning to its sort of pre-pandemic kind of existence.
It's still not quite there, right? Because I don't know what these numbers mean, but there's 10,
Yeah.
the 10 line, the bottom line there, is it keeps getting touched prior to COVID, and
Yeah.
we're lucky to touch the 15 line occasionally since,
Yeah.
right?
So we're still a little bit elevated,
Mm-hmm.
but we're definitely on our way back for really the first time in a long time. So, I mean, this is a classic market story. It means that it's an indication that there is a more consistent environment, good, bad, or indifferent, that we're experiencing now. It's back to normalcy, and normalcy is, you can love, hate, or feel indifferent about normalcy as it exists today, but we're leaving an era of extreme disruption.
Right. Yeah, and I guess the advantage to something like this, it may seem crazy to talk about this as like a chaos index or whatever, but think about it. Tell me if this is a terrible analogy. I'm thinking of the betting markets for voting
Yep.
for elections, right? And people will look at those and to some degree take them seriously. For like a U.S. presidential election, you can see people putting their money on who they think will win. And the thing about that is, it's when people are putting money on the line, it can sometimes be, how do I put it, clarifying,
Yep.
as opposed to just asking someone's opinion. Um,
Well, and the other thing
right?
is, uh, particularly the financial markets are a money weighted average of opinion rather than an opinion poll, which means that
Hmm.
if you don't have money invested in the market, your opinion doesn't count. So it produces what is a much more effective predictor of the significance of certain events. So
Right.
the example I like to point to here is find me on this chart Donald Trump's election in 2016,
Wow.
right? So in the sort of chattering classes, this was a dramatic changing event for the
Yeah.
story of
And
America.
they were screaming at the sky and all this stuff. Yeah, yeah.
Yes, but it
But
turns out this is processed by the market as a remarkably insignificant event,
right,
right?
right. In fact, there is a spike I notice in sort of the fall of
That's in fall of
2015.
2015. That's a year before.
Oh wait, I'm sorry. He got. Oh, I'm sorry. I
That's
get
right.
mixed up.
It's even less than you think.
Wait, 17, 18, 19, 20. Oh, I see. That's right. So he's. Oh, wow. So it's like nothing. It's just
Yes.
another day in the market, basically. That is interesting. So from the financial markets point of view, it's kind of a non-event.
It's a completely non-event, and you can see it
Wow.
like if you look at the actual reorganizations in the economy during the Trump presidency, you can see that the market was correct to treat it as a
Mhm.
non-event.
Right. Hey, just since we were talking about it and we've got the chart up, let's look at the Ukraine war. I've got my arrow pointing, hovering above what would be roughly the beginning of the Ukraine war,
Yep.
early 2022.
Yep.
Again, eh, I don't know. There's a lot of spikes that look like that.
Well,
So
you can kind of see that
might
there's
mean
an
nothing.
escalation in volatility in the period leading up to it, because one of the things
Hmm.
people forget about the Ukraine war is that the Ukraine war didn't happen out of nowhere.
Yeah.
People watched escalation in Eastern Europe for a period of time,
Hmm.
and so you can see higher volatility in like early 2022 than in late 2021.
Hmm.
But you're not talking about a kind of earth-shaking event for the
Yeah.
financial interests of the sort of G20 companies.
Yeah. It's compared to the spike with the beginning of lockdowns. It's there's like nothing.
Yes,
It
and
doesn't matter.
the spike with the beginning of lockdowns. To be clear, you could go back the entire history of the VIX and not find another event as significant as the lockdown.
Really?
Yeah,
Oh, now that is worth dwelling on for a moment. So what about like 9/11?
9/11 is a big spike,
Okay.
but the spike for lockdown is quite a bit larger than 9/11.
Really?
2008 is a big spike, but the lockdown spike is bigger.
Wow. I
And I
would
th-
not have guessed that.
and I think we can examine transformations to society that followed and conclude that in fact the volatility index is accurately assessing the effect to business of
Mm-hmm.
the particular action in question.
Right.
9/11 was a dramatic event, but the effect to business, like there were all kinds of people who thought that this was permanently damaging to the airline industry. In fact, not, right?
Mm-hmm.
There were a lot of people after 9/11 that thought that it would dramatically change U.S. foreign policy for a long period of time. In fact, if you look at U.S. foreign policy, you could you can see the effect of 9/11, but it's not the character of U.S. foreign policy before 9/11 and the character of U.S. foreign policy after 9/11 is quite similar.
Mm-hmm. That's interesting. Right. So, okay. So I guess what this tells us is that of the events like 9/11 and the 2008 crash and so forth, the lockdowns, where they were literally just like shutting business down,
That's the
was,
biggest event in
yeah,
the financial markets in your lifetime.
yeah, right. Yeah. Wow.
And, we don't have a volatility index that goes back before I think it was born in the early 90s or something. But
Mm-hmm.
if you had a volatility index to measure the effect of like Pearl Harbor or something, maybe you'd
Yeah. Yeah.
see something similar. But
Right. Right.
you're talking about in the lockdowns a kind of event that will have echoes like 30, 40 years from now. Whereas
Right.
the effect of 9/11 on the business community, there, it means we have long lines at airport security. What else does it mean?
Yeah. Right. Right.
I
Right.
don't know.
Long term. Yeah. Um, okay. And I'm sorry. Did you explain what VIX actually is?
Yeah,
Uh,
we did that.
okay. Yeah. Yeah. The options. Options volatility. Okay. So let's look
And
at another.
John's
Go
son
ahead.
in chat is asking, is it lockdown or is it the free money?
No, that came later though.
A metric like the volatility index is not telling you what about the specific event is causing disruption, just that there is a transformation occurring.
Yeah. Well, but also the free money came later.
Yeah,
Right.
although in the U.S., there was like a TARP package almost immediately,
Okay.
so it all kind of comes together. But the spike is the processing of the reality that you know the Western world is going to respond like China, which is
Mm-hmm. Right.
it, it's a thing. So
Yep. It happened, and it was big. Um, okay. Then let's also look at natural gas. This is a story we were following closely, and you can see why, because the spike up in the U.S. was not fun, but not too terrible. The spike in Europe, and that's those what do you call it, red, green, and pink lines or whatever. The spike up in Europe was just crazy. I mean, you see it at certain points hitting near 2,000% higher natural gas prices. So this is a really big deal. Now, since then, it has settled down to being uh, okay. Am I reading this right? Is that plus 151 plus
yeah,
151%?
151% higher than it was
Okay.
pre-pandemic.
Okay. So about a 150% of what it was. So double and a half, I guess, right? Is
Yeah,
what that
and
means.
151% higher than it is in North America.
And then well, that's what I want to talk about, mostly the European thing. But as you pointed out with this US, the orange line at the bottom, we are now back to where we were before any of that. And in fact, it's actually down a little bit, the
Yeah,
natural
this
gas
is what
prices.
caused me to come back to this story is that natural gas returned to pre-pandemic lows on the on the CME this week. So when I screen capped this earlier today, it was down 4% below pre-pandemic reference points.
Wow.
But and so what you see is that the war in Ukraine, the like insane Biden energy policy, all of this stuff has come. So natural gas is important because it's the most important fuel in energy generation and in home heating.
Hmm.
So it's a pretty fundamental. Oil and natural gas are the two fundamental sort of energy commodities that are globally traded, and you see here there's a somewhat of a disruption in the North American market, intensifying substantially after the Ukraine war, but really
Hmm.
beginning with the Biden election.
Hmm.
And then we're now past that disruption
Yeah.
in terms of processing, which is really interesting.
Yeah.
because it's not like we went and reversed all of the like insane you can't drill anywhere policies of the Biden administration.
Hmm.
But somehow or other, producers have found a way in North America to find enough natural gas.
Yeah, we'd have to be bigger insiders in the industry to understand how it adjusted. But I mean, as an economist, right? There's this equilibrating mechanism, right, where um, there's just so many ways the market can deal with things. It can substitute. That is, maybe they weren't able to bring more natural gas production online, but people substituted into some other energy source, and on and on and on.
Yeah, I
There's
mean, if you
many,
look
many ways for the economy to adjust to a higher price.
if you
Right?
look at raw consumption numbers, natural gas consumption in North America is actually up year over year.
Oh,
So
oh, okay.
what
So
you're
that
looking at is a
not
story of
substitution then.
it's a story of producers finding a way.
They found a way somehow, right? Yeah.
Yeah,
So if an industry insider might be able to tell us that story, right?
yeah,
How exactly they did that. Anyway, but let's go back to Europe then. Um, and here we find that what looked really frightening last year, and we were talking about, will Europe starve or freeze? More relevantly, as they went into the winter, it was not a good situation as they went into the winter. As you can see, it was still very high natural gas prices, and we heard some horror stories of people's energy bills and so forth. But it's calmed down, calmed down, calmed down to where it's plus 151%. Now, you were telling me that you don't see this continuing like the US did. You don't see this continuing to come down and hit where it was prior to, back in 2021. Why is that?
yeah. I mean, when I look at so there's a couple of reasons, but when I look at this chart, first of all, it looks like European natural gas is finding its footing and trading, beginning range bound trading. But more philosophically, the supply of European natural gas is now coming via more expensive mechanisms.
Hmm.
Critically, it's you know, being shipped to port instead of being delivered via pipeline from the east.
Right.
And what you're seeing here is now the sort of processed increase in delivery costs to Dutch port. And Dutch port is probably kind of the low end of the increased cost there because it's natural gas at port as opposed to natural gas, for some random German business who needs it to refine steel or whatever. So this gap is probably a little bit larger at the actual point of consumption. But it looks like we're finding a stable equilibrium for the price of natural gas through its new delivery mechanisms to Europe.
Right. Right. So when we say equilibrating, sort of settling down, the market settles down. It doesn't do miracles, right? It doesn't make bread from stones. Namely, no one has figured out yet how to get back to the cheaper transportation deal that Europe had with Russia before the sanctions, right? With the sanctions in place, even after sort of getting the new mechanisms in place and everything settling down, uh, gas is going to be more expensive because
Yeah.
it's just there's a fixed cost of moving it around now that wasn't there before, and that the market doesn't can't make that go away, right?
Well, and even if the sanctions ended tomorrow, you still have the whole issue that the pipeline doesn't exist anymore. Right? So you could turn the sanctions off, but you can't magically make the pipeline come back
Yeah,
into
right.
existence.
Infrastructure, yeah,
So
infrastructure
and
destruction.
and I like Nord Stream 2 is gone, but I don't think that the Poles or the Ukrainians are going to be excited about shipping natural gas through their territory from Russia anytime soon.
Hmm. Yeah, so no prospect of even that coming back, even with peace.
Yeah.
So bad news. Frozen in the chat says my gas bill in December 2020 was 57 pounds. In December 2023, it was 206 pounds for pretty much the same gas usage.
Yeah. And some
So
of
yeah,
that is
brutal.
disguised. So, like, I have a similar situation in Canada, even though gas is cheaper here than it was pre 2020. but our like ridiculous green taxes have gone up in the interim,
Mm,
right? So I pay almost double at the pump and almost double to heat my house that I paid, you know, when oil and gas prices were at similar levels. But that's just taxes disguised as pricing.
right.
So
Uh-oh. Uh, okay.
do you have an issue
Sorry.
there? I hear
I just
background
heard a,
noise.
I just heard like a dog barking. Let me just glance real quick. Okay.
Yeah, well, for the audience, you're listening to the farmyard in Radlib's backyard. So I was hearing chickens and dogs this whole time. So hopefully
I
the
don't know
dog
what
is.
that was. We have a lot of wandering dogs in our neighborhood, and
There you go.
they're not always safe. So, okay. All right. Then let's now turn to where am I? Okay. U.S. government bonds. Okay. Now this is the value of the bond. No.
This is
What are
the
we looking at?
value of 10-year U.S. government bonds. So the TLT is an investment fund that people can buy, and all it does is it takes your money and it turns around and buys 10-year government bonds, and when they age out to 9 years, it sells them, and then it buys the like 10.5-year bonds over and over
Okay.
again.
So this is where you want to stay at that 10-year time horizon for whatever reason.
Yes. So for whatever reason, that's your investment of choice. But it's a really useful vehicle because it gives us a real mechanism for tracking the price volatility in U.S. government bonds.
Right.
So,
So we see it spike up in with the again with the lockdowns. That's that high point, right?
yep,
And why would the value of 10-year T bills go up at that time?
because it's a kind of flight to safety
Okay. I see. I see.
effect. And not
Right.
only that, there's the anticipation that interest rates are going to be low for a long period of time. Therefore,
Mm-hmm.
bonds that have some coupon are valuable.
Got it. Okay. And then that it stays quite elevated compared to where it was throughout 2020, right?
Yep.
And even to some degree into 2021. But man, 2022, we
Yeah.
down we go. So what's going on starting in what about beginning of 2022?
So, the beginning of 2022 is when it starts entering into Fed discourse that inflation is really a thing, and therefore interest
Mm,
rates are going to have to go up.
right.
And so you saw the most severe bear market in government bonds, well, in bonds generally, in my time in the industry.
Oh
So
wow.
this goes back. This chart here is a 20-year chart, and it's very obviously the most severe bear market in bonds in that 20-year chart. You could extend this chart back. Well, you can't because TLT is only 20 years old. But
Hmm.
if you had a similar product going back to like, you'd have to go back to the bond markets of at least the early 90s to see events of this size in the bond market, which makes sense because the kinds of changes that have gone on at the Fed are as large as they, like the last comparable changes are in the 80s and 90s. But the point of highlighting this chart is not that there was a really bad bear market in bonds. We all know that,
Mm-hmm.
hopefully. The point is to highlight that in the last, couple of months in 2023,
Mm-hmm.
U.S. government bonds have found stability for the
Mm-hmm.
first time in quite a while.
And shouldn't this be surprising in a way because they're oh well okay I'm forgetting they have been doing rate hikes so increase in interest rate and usually that's going to have an effect on the value of T-bills, right?
Yep. So what
um,
this is telling you is that the market is not anticipating significant further interest rate hikes.
okay, I see.
So, right, I mean, the Fed could change course. You could see that the market was not correct to interpret that interest rates would stay low for a long period of time after 2020.
Mm-hmm.
But right, wrong, or indifferent, you have stability in the bond market for the first time in quite a while.
Right, and not for a short amount of time. I mean, it looks to me you could call it roughly
Basically, since the
half a
beginning of
year.
2023.
Well, it even goes back before that a little bit.
Yeah.
So something like half a year. Yeah. Yeah. So this is not. We were discussing what to do with the show today because there was no like sort of headline event like Silicon Valley Bank or something like that. And so it's nice to visit in on this because this is, as I think you've been showing here, this is not like, hey, things seemed stable yesterday. You've waited to bring this up until we actually have some months of stability across almost everything we've looked at here, right?
Not only
Um,
that, it's very significant in the light of the quote unquote banking crisis that occurred earlier
yeah,
this year to note that the indicators of the financial markets are showing a return to stability, not a crisis moment. So you
right.
saw a lot of commentators in a lot of different spaces, you know, express concern that uh, the banking the bank failures earlier this year were kind of a return to 2008. Well,
Hmm.
that's really not what you see in the broader market indicators.
Yeah, the market didn't seem to think that.
Yeah, and
Right,
we're now whatever it is a month on. There have been no further bank failures.
right.
It might not be good for business for certain kinds of firms, but you're seeing a stable meta, not a disrupted meta.
Right. Yeah, and this is something I really picked up reading Rothbard's book on America's Great Depression, I believe it's called, where he points out that there's a huge difference when you're looking at trying to understand what's going on in the market. There's a huge difference between like market-wide events and sector-specific or regionally specific,
Yeah,
right?
yeah.
So yes, Silicon Valley Bank. Was that quite painful, or did that cause some adjustments within the startup banking industry or whatever? Right. Yeah, yeah, absolutely. So some money fled Silicon Valley Bank and went elsewhere. For that money tied up with startups, tech startups. But that's this one little area of a very, very, very big economy, right? And so pretty much everything you've shown us here in the volatility section are market-wide type indicators, right?
Yeah.
They're not focused on some particular part of the country, some particular sector of industry. It's an overall measure. And from the point of that overall measure, it turns out that things like Silicon Valley Bank going down, Trump getting elected, and so forth, pretty much it's as if they didn't happen.
Yeah, yeah.
Right?
Whereas there are some events that have occurred that really, do have lasting impacts.
Yeah.
For example, the Fed.
Broad and lasting impacts, right?
Yeah,
Yeah.
for example, the change in Fed policy that has occurred over the last, year. You can see echoes of that, you know, all over the world.
Mm-hmm. Right.
So,
Yeah. Even beyond one country, international impacts, right?
yeah.
Courtesy of the dollar as global reserve currency. Okay. Then finally, one more thing to do before we're done. These econ minis have been starting to be like minis, like shorter shows. It's not a bad thing. It's kind of what the show was meant to be. But anyway, um, house prices. Okay. So first, before we jump to the right, let's look at this hump here in the middle. That is the 2007, 2008, what has sometimes been called a housing crisis, right? A particular real estate crisis, particularly showed up in there. We see housing prices going up, peaking, and then really dramatically dropping. Though notice that all they did is just sort of return to where they, you look at 2012, you go backwards, it's where it was in 2004,
Yeah.
8 years before. So keep it in perspective. It was no question. It was a very big event. It had a lot of long term implications. We did a series on it with Black Horse, but it didn't like housing prices. If you were patient, if you had real estate and you just sort of rode it out and you hadn't bought at the top of the bubble, if
Well,
you know
even
if
if
you
you
just
did
held your
buy it,
real estate through, you'd be okay.
even if you did buy at the top of the bubble, like
Yeah, just wait 10 years.
10
Yeah.
years, okay.
Right. Right. Which, to be fair, in real estate, I mean, I don't know what it's like for movers and shakers like you, but for most of us normal mortals, real estate is a long term thing. We're not like buying and selling every few months, right?
Yeah, well, you would hope, right? Transactional
Yeah, yeah.
costs are very, very high.
Yes.
You don't want to, and not only that, the disruption to your life is quite significant. So it's not a good thing if people are buying and selling their house every 6 months.
Right. Yeah. And there's people who flip houses, right? I know I have someone in my family who does that.
Yeah, but
And
that's
that's a business model kind of a thing. But
well,
yeah.
but it's also like it's a way of getting paid for construction that is tax
Mm-hmm.
efficient because of the special
Mm.
tax treatment for buying and selling properties. So
Got it.
it's not really right to think of those people as real estate investors. They're construction workers by a different name.
Okay. Think of it more as interior decorating or something, right?
Yeah,
Take this house, make it look nicer inside, sell the nicer looking house.
yeah,
Right.
yeah,
Effectively, you've sold an interior decorating job or
yeah. An
whatever.
interior decorating job, sometimes like a structural renovation job.
Yeah. Yeah.
You know,
Right.
depends on the situation.
That's a good point. I'll have to mention that to that person as a perspective on what they do. Anyway, okay, but then so 8 years later, after that peak, we're back where we were in 2018, and it keeps climbing and climbing, such that at 2022, what is that? So it looks like about a year ago, we hit a new peak, which is way beyond the previous peak. I mean, this is significant. I don't know what these numbers mean, but it's like a
Yeah,
doubling of the index number nearly.
it's just an index compared to a reference point, so it's not
Yeah,
really doesn't really mean anything.
in
But
terms of dollars or anything. Yeah.
yeah,
But anyway, it's no question that the movement from the 2006 peak to the 2022 peak, that's some significant movement in the real estate industry, right?
yep. And when we looked at
We've
this,
gone so far as calling it a bubble.
when we looked at this in the context of the 2008 series, we actually raised concern that just looking at the chart, it looks a little bubble-ish,
Yeah.
and it was worth. This is a story that I think we're probably going to be following in 2023, 2024 a little bit
Yeah.
because it's not clear what the consequences of the drawdown of this bubble will be. Obviously, the 2008 real estate bubble had very broad social and economic consequences.
Mm-hmm.
We're not making a specific prediction here, but if we continue to see the air come out of that bubble, it would not be surprising to see some fairly broad consequences come out of that.
Mm-hmm.
So,
Right. And do we end up with what we would call just a regular bust, meaning a correction, I guess is what I'm looking for.
yeah,
Do we end up with a correction where we just, I don't know,
maybe
draw a
return to
line?
trend line or something.
Yeah, return to trend line, right? So that, you come down to, let's see, what would that trend line bring you? Let's say that this, right now it's
Maybe
at,
240 on the index, something like
yeah,
that.
exactly. Yeah, like you hit 240 and then it stabilizes.
Yeah.
That would probably be the happiest story to come out of this, right? Like the bubble has been resolved, but there's not like a general collapse in real estate prices so that people who own real estate are like, oh my goodness, I am underwater on my loan and, all that crazy stuff, right? Um, but if it goes below 240 and starts going to like 200 or below, I
Well,
would think that's a different story, right?
yeah, it's also interesting to think about if to come back to 240, that's another whatever it is, 10% out of real estate prices.
Mm-hmm.
It's not obvious to me what the broader social and economic consequences of another 10% coming off the top of real estate was, right? It wasn't obvious to very many people in 2008 that the consequence of like a 10% decline in real estate prices would be like the systemic collapse of the entire banking industry, right? And
Right.
then this massive set of bailouts and restructuring. So I I'm not making some prediction here about what the consequences of that will be, But
Hmm.
I think the fact that you see this dissonance between the rhetoric coming out of the Fed and what you see the market interpreting as future interest rates likely to be, the inverted yield curve, this symmetry bubble versus correction in the housing market. Uh, I think there's a story here to be followed.
Yeah, right, right. And this is such a marked decline for what is this? It's a little hard to tell from the way the axis is on this, but it's
Peaks
been a
about
year.
2022, yeah.
Yeah, yeah. So we're looking at near a year and a half of housing prices going down. So that's and it's not going up and down. It's only going down for the
Yeah.
last year and a half, right?
Well, and if you look
Um,
at the Case-Shiller index,
mhm,
volatility is not normal for the index, right? So this
mhm,
chart goes all the way back to whatever it is, 1988. So it's as
mhm.
long as my lifetime.
Yeah,
And during that period, there's only one sustained period of decline in real estate prices in 30 years, and now I guess two. So
yeah, right,
uh, it's a huge irregularity, and so we'll have to kind of follow it.
right. But it looks like the way the movements are very gentle here over this what 40 years, well, maybe 30 years, I guess that this is showing or so. Um, and so if we check on this in 2 weeks from now on our next show, it's not going to be very exciting, right?
No,
Right. It's more like we need to check in on it like a half a year from now or a year from now or something, right?
that's right. So
To see where this little story is going.
the last time we looked at this was when we did the 2008 series, which was maybe like 18 months ago.
Hmm.
So
Right.
this is something to follow here. And if we start seeing problems in the non-deposit taking part of the financial industry, or if we start seeing the Fed reacting, this is probably the storyline that is going to be responsible for it. Of all the storylines that we already have, this is the
Hmm.
one that you're going to see that the next shoe to drop will be related to.
You mean if real estate prices continue to fall, you can see institutions starting to scramble because of that.
Well, yeah, because so far you're looking at like a 5 or 10% retracement in real estate prices, which doesn't disrupt the lending markets, right? But typically, even traditional mortgages, recently written mortgages, it's common for a borrower to have like less than 30% equity in a home,
Hmm.
which means that if you see a price correction in real estate that approaches the scale of 20 or 30 or 40%, you see a lot of social action that disrupts the banking system.
Hmm.
Because if those loans are underwater, then there's no good reason why, like good financial reason, why the holders of those loans don't walk away.
Yeah. Oh, yeah. Right. Which is a problem, right?
Well, that's the fundamental risk in real estate banking is the negative equity situation.
Right. Being underwater. Right.
So,
Yeah. Right. Because then the incentive is disappear.
yes,
Right.
disappear, take the L, start again.
Yeah. Get out of it and
And so
leave the bank holding the bag.
that's
So
right. And
yeah.
that's as those who have who've watched real estate in more general terms know, that's like the kiss of death
Yeah.
for the real estate market, because then you have like foreclosure sales and you have all of the social consequences that go with that. Because
Right.
if there are foreclosure sales, banks will not write new mortgages,
Mm.
right?
And we saw all this in the aftermath of the 2007 2008, if I remember correctly.
Yeah,
Right.
yeah,
Yeah.
absolutely.
Yeah. Right. And we're not seeing that despite the steady decline in prices for a year and a half, maybe. We actually are not seeing those kinds of things yet.
We're not there
Right.
yet.
Yeah.
The key question is, can this does this go on, and if it does go on, how far does the system have to be pushed before you see a discontinuity? Right.
Mm-hmm.
This is
Yeah.
exactly what we talked about when we talked about the failure of SVB. You had this pressure building up in the deposit business with these unrealized losses, and then
Mm-hmm.
very
Right.
suddenly that pressure translates into bank failures.
Mm-hmm.
And so the real estate market is another place where you have pressure building up, and maybe that pressure is relieved with no issue, especially if the Fed reverses course.
Mm-hmm.
But if it's not relieved, then you may see a discontinuity.
Right. Yeah. A lot of people losing their homes, right?
Yeah, very exciting. Everybody loves losing their home.
Yeah. And the bank does not like being left holding the bag.
No.
So,
Turns out your bankers don't want you to lose your home either. Very interesting.
yeah. Right. They're against it. Okay. Yeah, Lumberg makes a good comment. Kills neighborhoods and communities too,
Yeah.
and it has a social effect, right? Social impact. Okay, I think that we're covered there. I believe next week we will be back to wrap up the Left Wing Terror series. I hope everyone enjoyed, in scare quotes, my little bonus episode about Jim Jones. Turns
Yes.
turns out that Black Horse had an interest in Jim Jones before I did, I think. Not counting when I watched the TV movie about Jonestown,
Yeah.
like a year after it happened, probably before you were born or something, or around the time you were born. I don't know, something like that.
Yeah.
That did catch my interest, but then I didn't like dig into it. But you actually did get interested
Well, I
when you were
learned
here,
about
right?
Jonestown when I was like 9 years old from a TV documentary in Florida, and it was like my 9-year-old brain couldn't handle this. It was,
Oh wow, you were
it
like,
was,
whoa,
I couldn't understand that this thing existed.
yeah,
So,
yeah, yeah. Well, this is what got me started on mass murder by states. I was around that age, just slightly older, when I
yeah,
started reading about mass murder by states, because it was that same kind of thing. Like, wait, like millions of people were just like killed in the 20th century.
yeah,
How is that a thing? How does that happen? I would like to understand this, and that really woke up an interest in history, social theory, and so forth, which led me to economics and many other things.
yeah. Well,
Um,
it's probably the first piece of interest I had in mimetic behavior, right? A lot of the things that
mm,
I'm interested in the financial markets have to do with this quality of the irrational nature of human behavior, right?
hmm.
Big fan of Rene Girard and the kind of theology of the political mimetic violence, all of this stuff.
And
So,
this is
anyways,
also, I hope I'm not mischaracterizing it. This is what sometimes in the financial press is called like contagion,
yeah,
right?
yeah,
Yeah,
yeah. Alan Greenspan used to call it like the dichotomy of irrational exuberance, and
yeah.
it was the other side of it. Anyways,
Sounds like big words to say something that could be said more simply. But anyway,
it's Alan Greenspan. You gotta give allowances.
um, okay. So thanks everybody. Thanks for didn't get to respond person by person, but a number of people wished a happy anniversary to Mrs. Redlib and myself. Much appreciated. And thanks to Black Horse keeping us on an early schedule for Econ Minis. We're gonna have time to go out and have some dinner here. So even while doing my workday and my show, amazing. Thank you,
Well
Black
done.
Horse, once again. Very good. And see you all next week.